Hello everyone. I, Karishma Subarnikar, welcome you all on behalf of MI Capital Services to our new series on UAE Corporate Tax Simplified for you. We bring to you a series of videos simplifying the proposed UAE corporate tax for better understanding by sharing our insights on the same. So let's start without wasting any time. Today, I would be explaining about the transfer and set-off of losses and calculation of corporate tax liability under the UAE corporate tax regime. Now, some business faces loss in the initial stage, for example, the startups, and sometimes also due to market conditions, the profitable businesses also make losses. Under the UAE corporate tax regime, tax is to be paid on total profits of a business over its entire life cycle rather than a single financial period. Hence, as per the international trade practice, businesses will be able to offset the losses incurred in one period against the taxable income of future periods, but subject to one condition, that only 75% of total income can be set off as for the losses. I would like to explain this with the help of an example. Now say if any company has a total income of 50 million AED in 2025 and it had incurred a loss of 40 million AED in the year 2024. Now then this loss of 40 million AED, only 37.5 million, that is 75% of the 50 million AED income of 2025 will only be allowed to offset in the year 2025 from the total income of 50 million, and the balance loss of 2.5 million which is being left from the 2024 will be carried forward to the future years, and hence the taxable income for the year 2025 will be 12.5 million, that is 50 million income which is being earned for 2025 and loss set off of the previous year 2024 of 37.5 million AED. The balance income of 12.5 million will be taxable at 9%. Now you must have a question that till when can we carry forward the losses which we have incurred in a certain period? So interestingly, tax losses can be carried forward indefinitely under the proposed UAE corporate tax regime. But there's only one condition to that, and the condition is the same shareholders hold at least 50% of the share capital from the start of the period in which the loss is incurred to the end of the period in which loss is set off against the taxable income. Now, even if there is a change in the ownership of 50%, tax losses may still be carried forward provided the same or similar business is being carried on by new owners. Now, for this also I would like to take an example. Suppose, say Mr. A, B, C, D are shareholders of the company ABCD Limited, that is dealing in trading of automobile parts, and each are holding equal shares of the company in the year 2024. That is, each are holding 25% shares of the company, and they have incurred a loss of 10 million AED in that year, that is, say in the year 2024. Now, in 2025, Mr. C and D met an accident and his shares were taken over by Mr. F. And Mr. B sold his shares to Mr. E. Now, Mr. A, E and F are the shareholders of the company that are holding 25%, 25% and 50% of the shares respectively against the previous ownership of 25% shareholding of each ABCD. Now ABCD is still continuing to operate the same business and it has earned a taxable income of 30 million in the year 2025. As per the corporate tax regime, there has been change in the shareholders as 75% of the shares has been taken over by another shareholders since the loss was incurred. As the loss was incurred in 2024 and there has been income in the year 2025, but the shareholding pattern has changed. Now, even though the shareholding pattern has changed and more than 50% of the shareholders have changed, but the same business is being carried on by the rest of the shareholders, thus the loss of 10 million which is incurred in 2024 can be set off against the profits of 30 million in the year 2025. I hope this has given you an idea about how the set off of losses can be done with respect to this criteria. Now, this condition of continuity of shareholders or business requirements, it does not apply to businesses that are listed on a recognized stock exchange. So, businesses which are being listed on recognized stock exchange are being exempt and kept out of the purview of this losses category. Coming on to next aspect of the losses, that is which losses cannot be set off into the future periods. So, very firstly, losses that are incurred before the effective date of the corporate tax regime, that is any loss incurred prior to 1st June 2023 cannot be carried forward in the future, which is even justifiable as well. Secondly, losses that are incurred before a person becomes a taxpayer for UAE corporate tax regime can also be not set off against the future tax profits. Thirdly, any losses incurred from the activities or assets which generate income from the activities that are exempt from the UAE corporate tax, that losses can also not be set off against the future periods. And lastly, losses incurred by a free zone person that are not attributable to a permanent establishment in the mainland cannot be set off against the taxable profits. Moving on to calculation of corporate tax liability. Now, it has been said that the corporate tax shall be levied at 9% on the taxable income exceeding AED 375,000. That is, up to taxable income of AED 375,000, there will be no tax liability. Thus, it can be seen that small businesses has been given a relief under the proposed corporate tax regime. Now, what is taxable income? That has already been explained in the last video, and in case if you have missed that video, do watch so that it will be giving you a brief idea about what exactly is a taxable income. It has been proposed that the certain forms of income will be subject to 0% withholding tax. Well, what is withholding tax? Now, withholding tax is a tax deducted at source for certain specific types of payments made by the residents of a country to a person or entities outside that country. Now, considering the position of UAE as a global financial center and an international business hub, 0% withholding tax will apply on domestic and cross-border payments made by the UAE businesses. So, there will be 0% withholding tax on the payments made by the UAE businesses. Now, certain types of income shall be subject to 0% withholding tax, and I would like to elaborate these kind of income. Very first, UAE sourced income earned by a foreign company that is not attributable to a permanent establishment in the UAE of that foreign company, it will be subject to 0% withholding tax. Secondly, mainland sourced income earned by a free zone person that benefits from 0% corporate tax, that is, which is not subject to any corporate tax regime, then it will be also subject to 0% withholding tax unless the income is earned from the mainland branch of that free zone person. And lastly, any dividends or other profit attributions made by a free zone person who is benefiting from a 0% corporate tax regime to a mainland UAE shareholder will also be subject to 0% withholding tax. Now, given the proposed withholding tax at 0%, UAE businesses will not be required to make any deductions from the payments, nor will there be any obligation to file any withholding tax returns. Moving on to another important element while calculating the corporate tax, that is tax credits. Now, as discussed in the earlier videos, UAE resident companies will be subject to UAE corporate tax on their worldwide income, which also includes their foreign sourced income. Now, this foreign sourced income, which may have been subject to tax by any other country, and thus it may lead to double taxation on the income earned by the UAE resident companies. Thus, to avoid such double taxation, foreign tax credits are allowed to such businesses. Now, the maximum foreign tax credit that will be allowed will be lower of first, the amount of tax paid in the foreign jurisdiction, or the corporate tax payable on the foreign sourced income in the UAE, that is at rate of 9%. Now, any unutilized foreign tax credit will neither be able to carry forward to future tax periods, nor FTA will refund any unutilized foreign tax credit. Thus, in a nutshell, I can say that the corporate tax liability shall be calculated as follows. Very first, corporate tax will be calculated on taxable income above 375,000 dirhams at the rate of 9%. From this tax calculated, Foreign tax credit, if any, which is available, shall be deducted, and then we shall get the corporate tax liability at the end. Now, this taxable income, which is being calculated above 375,000 dirhams, it will be calculated after a set off of any losses, if available to the company, and then on that 9% of the corporate tax shall be laid. I hope this video has given you an idea about the calculation of corporate tax liability on taxable income and treatment of losses under the proposed corporate tax regime. In the next video, I shall be explaining about the tax groups and their analysis under the proposed corporate tax regime. Till then, stay tuned and do like, share and subscribe to our channel to never miss any of the upcoming videos. For any queries or doubts, do feel free to reach us. Link and our website contacts are being shared in the bio. Thank you and keep smiling.